What's up, everybody? Official Trader again. Here we go. Back-to-back videos rolling out today. I gotta take my time to get them to you. What are we gonna talk about? We're gonna talk about maybe a few things, but one thing I want to mention is indicators. What are your favorite indicators? People do ask me that. What indicators do you use? What moving averages do you use? What do you prefer? Well, honestly, I'm still in experimental phase because I really only picked up technical analysis earlier this year. When I joined Trader Circle, Kevin got me on it, and I've just been evolving myself from that. One pattern, it's not really an indication, it's more of a pattern that I've used consistently. And back when I was doing all the strangles and all that, because you never know when a stock is going to reverse out of nowhere for no reason, or some drastic news happen like Google's going to buy the company, or Amazon's going to buy the company, or something crazy like that. Amazon shares will go down $20, and this one goes up 20. On the other side. So that doesn't happen often, but it does. Matter of fact, we're going to talk about one thing real quick: reverse splits. I have two little baby penny stocks in one of my accounts that I just let sit there for one. What do they do? It's one of the cannabis companies coming up. It's OTC market. It reverse split the other day, like some ridiculous amount. I think it was like 60 or 100 to 1 or whatever. I had 100,000 shares. Now I got 614 shares. They opened at 10 cents. I think it was actually profitable for like a minute. They opened at 10 cents, and now they're already back down to like 6. Reverse splits lose money, baby. I don't know what to tell you. I don't know, unless the company's going to be amazing in the future, I'll just let it keep doing what it's doing. I'm not going to bother. It cost me, I think it was $20 is what I opened it with, and it's just going to do what it's going to do. And I really don't care. It's okay. IMPX, I took a risk on it. I lost $1,700, but prior to that, I had made 4,000 on another one. But PCG burned me also. So you got to be very careful when it's up to government officials or any kind of deciding party about a stock's whereabouts in the next week or so, and you have shares. Options is one thing because your risk is going to be limited to what you paid, unless you're selling premium. But in the event that you overextend your account, you overextend your trade, you put too much money somewhere, and it goes against you, you are going to kill your account. It's called blowing up the account for short. But what happened to everybody holding IMPX where they had a statement saying that we want to avoid a reverse split because we want to grow organically, et cetera, et cetera. And what happened? That baby pumped up from like 2 or 4 cents and just built steadily. It did this. It went from 2. Hopefully you guys can see this. It went from 2, boom. All right, it went to like 10 or 13 cent and dropped right back down. Well, that's a little far. We'll go here. Went to like 6, and then it jumped back up to like 20, opened at 38, and had I been awake at right before pre-market, I get home at like 7ish, so I go to sleep. I skipped my alarm, so I could have got in at like 38 or 40 and probably sold at 50 or 60. But what I did is I actually screwed up. I chased it. I FOMO'd a little bit. I bought it at 58. It went up to 60. I was up $200 for a few minutes. And then it dipped, and then over the next, I think it was 2.5 days. Look, back to stock twits. Please don't be on stock twits trying to get investment advice, trying to figure out where the stock's going to go up or down. The only reason I have stock twits that I even look at it is because occasionally somebody will know what's going on. And if I feel like investing in a stock, I'll peep at it for a minute. And I'll look at just kind of what people are saying, because apparently stock twits is a lot bigger than most people think, because they're actually linked to Fidelity. You can actually see what people are saying on stock twits when you're browsing a stock on Fidelity. Now, whether or not other brokerages do that, I'm not sure. I don't really use other brokerages much. I like Fidelity the most. Why? Because I've just never had problems with them. Every brokerage I've ever seen, from TD Ameritrade, Fidelity, Ally, I haven't used Charles Schwab that much. Chase, I haven't had any issues so far. But Robinhood, Webull, they've all glitched. They've all cost people a lot of money. All the brokerages, right? This last week, like all of them did. I don't know what's going on really specifically, but it was very interesting. But anyway, so 58. So right here, right, you're capped out. I went ahead and cut losses here. I got out at 475, and so I lost, that difference there, which was about $1,700. I'm not worried about it. I already made 500 back in a couple of days. It's just a matter of trading a disciplined trade. Nokia, I think, is going to blow the roof off. Hopefully, well, not hopefully, but in the event tonight, we have more war talk. I'm going to pick more shares of Nokia back up. I might limit the extension. I might only do 5,000 worth instead of 10,000. and see where that goes. And this is an extension of what happened. So again, maybe it's at 475. This is literally like an hour before it did what it did. Because I knew once it broke that level again, because over the weekend, you know, it pumped up a little bit, got back to like 49. All right, I'm like, all right, cool. Maybe this is gonna run again on Monday. When it dropped to 47, I knew it was done. It tapped 44, bounced back to 49. I sold at 47. I undercut my current price, even though I lost $100 there. It's okay because I saved the other money. Because this is what happened next, where everybody kept saying, "Oh man, you people are gonna be like stock twists." God, I love these people. So stock twists are like, yo. People are like, oh great, we're gonna have to hear people posting how they sold, why they sell at 50, you know. But now I get those people are like, shit, we should have sold at 50. Because this is what it did. Boom. Where are you at? 28. Guess what? Boom. 17. Closed at 18. You know how much that drop was? 67% of your money. 67%. That's how much money you just lost if you held this like a dummy, because it was clearly pumped up. This whole move right here was only like 4 days, right? Now this first jump right here, this was about 2 or 3 weeks, and then it popped up to like, I think it was 13, but then it fell back down to 6. Everybody's like, oh man, that's a 50% drop near right there, and then more than that at 13, and then it shot back up, you know. So everybody's cool, jumped on the bandwagon, we're all gravy. And that was great, but this is why I don't really trade penny stocks. So yes, penny stocks are kind of sort of anything under $10 now, because if it did a reverse split recently, it could be up in that range. Like matter of fact, like I said, the one IMPX reversed 45 to 1, and that brought the shares to $9 a share at open, and which I posted in the Discord chat earlier. I'll put it on Instagram later. The real fish hook trader on Instagram. And the position literally was like, it was $9 and now it's worth, you know, whatever it is, but it lost majority of the money. But it was one share, so I really don't care. And I do those things to experiment, but also to prove a point, because unless somebody sees it with their own eyes, you know, or you can show them your personal experience, for some reason they don't believe you, you know. And everybody always says, like, okay, well, the split is good for the company. No, it's not. If a company splits forward, like they're providing you, if they're going to give you more shares than they're going to take, that's a different split. So you have a standard split, you have a reverse split. Standard splits have been done in like Apple, and I think maybe Baba, and then I think Amazon, and possibly Google. But when they split, they actually provided you more overall equity and growth factor, because they expanded the shares to get more money, and then obviously the company increased in value. So Amazon, Apple, Google, these things are like way up in there now, and that's amazing. So reverse splits. If you hear about a reverse split happening to a stock that you're holding, I hope you're not already down a lot of money, but the chances are, as soon as that sucker reverse splits in the morning, the very, very slight possibility for the people who have no idea what just happened are going to buy at $9 a share, because they think that the share just went up 30,000% or some crazy crap like that, and they're going to buy the shares, and that actually gives you an opportunity to get out of yours or unload yours. So hopefully you guys can still see this. Let's move on. Indicators, right? What indicators do I use? Now I mentioned the fish hook. That's not an indicator. That is a chart pattern more than anything. And I'm actually writing the best fish hook trading strategy for finding those stocks that meet certain criteria. I will sell this. I'm not going to give it away unless I do like a drawing or something. It will be copywritten material. If you redistribute it, you're going to get sued. But anyway. Indicators. What indicators do we use? Well, like I said, the fish hook, anybody can really use the fish hook alone, because you're basically just looking at an oversold opportunity. So like, for example, Nokia. So here we got Nokia, right? It was up here, I think let's see, the top of this was, I think it was like 510 or 520 a share. And all of a sudden, she gapped down, all right? Now, if this is live, who can tell me what a gap down is? So we got a gap down, right? We opened down here like 3, let's see, it was 4. I think it was like 4, because that's where it's at right now. It's actually forming a nice cup. So we're right here about 403. That's another reason I sold my shares, because if it does perform a cup and handle, it's going to push back down. I expect no less than 380, which is actually, because I actually bought down here the first time, and I sold it here at like 360. And I regretted that because then it went to 4. I could have pulled 40 cents per share, and that would have been a really, really nice trade there. Now, granted, then I only had 500 shares. But what we're going to see here is that in the event that the cup pushes through, then it's going to push back down, 385, 380, something like that. And then we should see this. If it fills this gap, guess what? We're going to go all the way. Let's move this out of the way. We're going to go all the way back up, most likely, because not always, but almost always gaps are filled. So you clearly see your cup here, right? You see the dip. All right, that's a drop. We have now, switch the color up, give you a little, hopefully you guys can see this. This is your fish hook, right? This is the accumulation phase. This is your buy point right there. If you bought here, you bought it like 250 to 320. I didn't see it at that point. It didn't come across the scanner I use, my strategy actually, until around the 350 range. And then that's where I actually started watching it more. I looked at the indicators long term, and we'll talk about that in just a minute. But sure enough, it's already up to this 4. I knew it was going to break 4, so I went ahead and sold. Here's what I'm trying to teach you all about limit selling orders. Because if you market buy, guess what would have happened if I had market sold these positions? It could have sold at 407. It could have sold at 401. It could have sold at 395 if somebody needed to fill that many shares. I had 129 shares on one account, picked up 5% on that one, and I had, God, how many I just sold? Several, I think it was 2,300. I had 2,300 shares. 2,300 shares sold at 4. I limit sold at 402, but it sold it at 403 because this was the current bid. The ask was 405, but I undercut myself. But guess what? I still filled at the current bid price. Awesome. That's the point of limit sales, because if I would have put 403 and it went down to 402, guess what? Now I got to put it at 401 just to try to get out. Now I lost 2 cents per share. Doesn't sound like a lot, but when you have thousands of shares, it makes a difference. So 403 is where we got out and sold actually on both sides. I limit sold 402 on both, closed both at 403. Fidelity shows you the price improvement, so that was a nice little bump. But we should see this gap fill, right? Based on resistance that I've seen on the past chart I've looked at, you're looking at, I had the limit sales initially set at 510, but because of all this war crap going on, I want to be very careful with the trade, just because I know I want to catch the nice moves, because had I sold yesterday at 4 and bought pre-market at 385 again, or not, no, I think it went to 387. So if I bought it at even 390, I would have picked back up 10, almost 13 cents a share times 2,300. So it's quick money, guys. You just have to focus on what you're doing, right? If I'd have had like 10 trades open and all of them lost half their value or 10% of their value because of the market drop last night, I'd have been freaking out a little bit. But I'm not, because I'm focused on one good trade. Because Nokia, I have long calls. I got 63 long calls, January 2021, all the way out in next year for $7 calls. I don't care if it reaches $7. If it reaches where I think it will at 5, I can unload those. I bought them at like 6, I think. If I sell them at even, I can sell them right now for $115 profit, but that's not enough. I want at least $1,000 off of the position. The position costs, I think it was about 400. I want to close it at least 1050 to maybe 1300, give or take. So I have a limit sale currently sitting, I think 0.25 per contract, which is a quarter per contract, which is $25. Your factor, if you didn't know that. Options, 25 cent means $25, because 25 cents, one contract represents 100 shares. So 25 cent times 100 is $25. So we're looking right here. I'm looking at the hard resistance of like 525 is passed. So I'm looking at 515 is going to be the next hard resistance after it breaks 410. All right, if it breaks 410, then I can see it filling the rest of the gap and continuing. But I do feel like it should, if it's going to perform a cup and handle position here. Market sellers and market makers know this, so this is what they're going for. They're going to actually watch it push down, and then they're just going to double down the volume here, because they're getting a 30%, not 30%, 30 cent share increase if they buy at the low, right? So, and we're talking, well, 20, In the event it goes a little lower, maybe cup and handle drops, some people freak out, they panic sell. But between 15 and 30 cents a share is what they'll automatically gain once it just jumps right back up to 403 to 410. When it breaks 410, that's going to be, to me, the signal to definitely have my shares ready, limit sell at, I don't know, maybe 590, something like that, because of a spike. But once it hits that 515 wall, I'm going to watch it. The moment it pushes back down below 509 to 503, I'm going to sell the position regardless. Maybe I'll keep 100 shares just to watch it go up more. But if it comes back down, I know I made the right decision. It is always better to take the profit than it is to try and hold for more profit, if that makes sense. Get some water. In the event, Callaway, good stuff. Not a paid advertisement. You just have to simply focus on what you're doing, you know. You don't want to just trade blindly. I've been watching this for a hot minute, so I'm more than capable of knowing where it's at. I even got another guy's advice, another trade group, to where he thinks the support was, and we both concluded that the 350 range was a solid support because it was way down here. I think 120 or 190 after being just ridiculously oversold, and that's excellent for me. So I'm looking at that as a potential really, really good play. Even if I've only scored $1 per share increase, that's going to be a very, very nice bump on my little account I got going over here. So real quick, back to the fish hook. This is a pattern that I use very often. So say we got to start performing this number, as we just did. It's forming a cup here, right? But where do we buy? How do we know it's a fish hook? How do we know it's not going to say screw you and come back down? That's possible, right? If you look back at Shopify, Roku, Tesla, Disney, all these different ones that have performed a cup this year, you've seen where this happened. It pushed and it said no, and it pushed it right back down, and it got down pretty far. I just missed that. So here's what we're going to do. We're looking for the fish hook. The fish hook is a dramatic oversold position. How do you know it's oversold? You can use RSI. You can use the percentage of share loss. You need to find out before you even get into trading why it went down. Did they stop paying dividends? Are they burning cash? Are they just losing money? Are they going bankrupt? Did they file for bankruptcy? This is where 10K forms on fundamental documents. You need to be reading those financial statements, or at least looking into them, or find somebody who does and find out what's going on. So what we're going to do, when we saw this massive drop here, sure, you could have bought it at $1.20 or $2 or whatever it was there. But the problem is, what if it kept going down? And now you bought it 120 where you thought was the bottom. And now somebody say, you know what, screw it. We're just going to keep pushing this down, and they get it under $1. Now you get a problem. Now you get a reverse split possibility coming because they broke the $1 New York Stock Exchange rule. And if they do, they're going to have problems. And Nokia is the company's been around forever. I don't remember the year it was founded, but overall, the company has a lot of growth potential. Now, whether or not we'll see $7 a share, not sure. The dip before this one was $11. It dropped down to $5. So you're talking about you lost 50% of your money twice. 90% if you got all the way and sold it at $1.90 or $2.10 or whatever the hell it was. But here's your fish hook right here, right? So say we see this and it does not continue down. It actually continues sideways. This is a good indication of accumulation. Because once it's accumulating this, and tons of people, you need to watch the volume to make sure it's staying very constant here. You know, people are picking up maybe large amounts of shares, and you'll be good. Because this, when it starts turning back up, that's your buy part right there. Yes, you can risk it and buy down here. That's entirely up to you. This is not financial advice. But this is where I purchase at 80% of the time, unless I have so much faith in the company, or it's just an extremely high probable trade that I know will go up, right? There's huge news coming or whatever the case. Now, Tilray or Beyond Meat that shoots up to $200 or $300 and then drops to $80, that still wasn't a good purchase price for those, because Beyond Meat actually continued further down. It went to like 73. I don't know what it's at now, maybe up a little bit to 80 again. It's staying in a very nice channel right now. But this is literally, just like it looks like, a fish hook, right? Now you have a reverse fish hook. But anyway, let's finish this one. So you buy here, say this is a 20 to 60 cent, difference, 350, maybe 50 cents, maybe $1. Maybe it spikes up and just shoots up to $6, or something like that. That's going to be a huge benefit. But check it out. Do you really want to risk this point, right? So say you bought from here, we'll say it's $3.50, you're selling at $4, right? That's 50 cents a share. No matter how many shares you bought, that's how much you made. All right. Are you really going to hold the whole position, or maybe sell half or sell 3/4 of it and keep a little bit to see if it continues up? And otherwise do like I said a while ago. And if it does come back down, stop loss right there. Or you could risk the whole position and stop loss it at here instead of taking profit. Now the problem is, if it says, you know what, screw it, investors are done, it gets back down. What about bad earnings or something? If it closes here and opens here, your stop loss is done. It's not going to do you any good. And you're going to get out right here. The first market open price below your stop loss generally is where you'll get filled at. That's a problem. Even a stop limit or a stop loss or a trailing stop loss is going to get burned the same way. I think you guys get the hint of this. I'm going to erase this. Since I mentioned it, we'll cover that topic real fast. Trailing stop orders are excellent. They can be a very, very good thing in your trading, whether it's options or just shares. So what is a trailing stop loss? You have an option. Let's go back to, let's do blue. Change it up a little bit. How about that? Haven't used this one much. So trailing stop loss. All right. Here's the thing. What is a trailing stop loss? Trailing stop loss is going to follow, like say you bought here, all right, and the stock moves to here. You set your stop loss here. When it comes down, if it touches that point, it sells automatically and becomes a market order to get rid of it. All right. Now, say this is, we'll try to keep it simple. Say you bought it $3. It moved up to $3.20. You set your stop loss at $3.20, but it went on up to, we'll call this $3.25, right? So you kept it tight, right? You kept a nice little tight stop loss. Now, the thing is with trailing stop losses, you can do percentages or you can do dollar value. Depending on how experienced you are as a trader, percentage values may be better for you, because you can actually sort of manipulate the idea that, okay, this stock has never lost more than 10% per share, or especially in a day, or it's never lost more than 5% in a day. So with that being said, you can actually, kind of value and gauge where you want to do that percentage value. Just for lack of confusion, we're not going to worry about that right now. And we're going to keep it at, say, a 5-cent stop loss, right? So you got to stop loss, you got over to 325. You're like, all right, you know what? Cool, I got 20 cents a share. I'm willing to lose anything down from the top profit back down to 320. So your stop loss hits, you're done. All right, you're out. Now, what if it only came down to 324? Well, that's not 5 cents, so you're actually still in the position. And now it decides to go up more, making more money. Now you need to raise your stop loss. All right, my guy, I told him to make sure he puts a stop loss on F-Cell, because F-Cell's been acting wild. I need to watch the chart. I need to see what it is today. I didn't look at it. I think it's at $2 range, but I should have got in that. But I know the past history, $3 was a huge resistance. By the time it really got my attention after it broke $1 for the second time, I was weary that it was going to just plummet back down due to a pump and dump. So we'll see over the next few days what actually happens with it. It could do well. The company history is moderate, but we'll talk about that later. So it went over. You didn't get out here because it went to 324. So your 5 cent is not met. So instead of 5 cent, now you're like, all right, cool. So maybe that was too much loss, or maybe you want to open it a little more. So you're still willing to lose back to 320, but say it went up to 4. All right, so now it's at $4. So now you've gained an entire dollar per share. All right, so now you're like, all right, look, should I take profit or should I just let this thing keep going? Maybe what you should do is sell half. All right, so get rid of half the position. All right, so now you set your stop loss at, I don't know, 380, right? So you're willing to lose back to 380 on the additional half that you left in the market. All right, if it continues up, guess what? You're still rolling, baby. But how far is your stop loss? So we had 5 cents. Now say we're up so much now, it went to 4. We set our stop loss at 380, or a trailing stop loss at say 20 cents. All right, I'm more of a fan of the trailing stop loss than I am the actual stop loss, just because I don't want it to fall all the way back down to $3 what I bought it at, or 320, when I could continue to move it up, because it trails the stock price. So in the event that it's a 20 cent stop loss at this point, trailing, and it goes to 4 and comes back to 380, boom, it's going to sell the other half, right? Or what if it only comes down 18 cents? All right, it's not going to sell. Now here's the catch. What if your stop loss is 20 cents, right? It goes up to $4. Your stop loss is 20 cents. Let's say it drops to 19 cents, but not 20. What does that mean? Well, that means that you're going to be over here at 381. And then tomorrow, it drops another 15 cents. All right. And then you're not watching this because you think you're good. Your trailing stop loss is fire. Now it drops another 20 cents. You just went back down from 381, to 366. And now you dropped another 20, so now you're at 344. So you just went all the way back down to 344 because you weren't watching it. You thought your trailing stop loss was going to do good. This is the opposite to where an actual stop limit would have stopped you here at, say you did 320. You're actually at the same place, but in the event otherwise, if this kept going in a trendy way like this, say it lost 15 and then it lost 19 and then it lost 18 and then it lost 19 again, it's just going to keep going down and down and down, and you're actually not protected. Because in the event that it continues that way, you don't have a final stop loss set in place, you're just going to lose the money, right? You're going to actually end up being under where you purchased from, which has happened to me before. And then that's where I really caught on to how it works, because you need to really, like with AXSM, I bought it at 88, I think it was initially, sold it at 100, turned around, made a huge profit on that. It was beautiful. Like $2,300. I did it again, except for I bought it back at I sold it, watched it, it went down to 90 again. I sold it back at 99, and then I bought it at, because it looked like it was going to pop, it hit 120 pre-market. I bought it at 109, and then it actually went back down to 100. I cut the loss on it. So I made plenty of profit on it, but then they actually took something away from me. But I had a stop loss on that for $10 just because of the amount of movement it was doing. But that mark didn't get hit, so the next day, it went down farther, and it was like, all right, so this could continually drag down in the event that it just keeps getting just before that stop loss. Now, if market movers are watching, say you're bragging about a huge position you have, and you catch one of those market movers' attention somehow. Now, I'm not saying they're looking at the little fish, but market movers look at orders, they look at black and white, they want to see where's, this 40,000 shares of this stock at, because that's what we want to pick up for half the price, and then turn around and sell it again after that. If they see a whole bunch of stop losses set at psychological places, 300, 350, 400, 500, 100, 200, even numbers, 350, those things are happening. Tesla, I guarantee, hits 498. I guarantee it goes over 500 within the next 2 weeks, as long as the market itself doesn't just implode due to war, trade, and all this other crap. If Tesla is continuing on its nice, beautiful run after just getting upgraded again to 556 per share, which is a very odd number for me. Now, I don't know what they're calculating that they came up with 556, but if they miss earnings, you bet your sweet pippy that I think Tesla's going to pull one of these drops like it did that one day. And not when it beat earnings, but the opposite. So it dropped from 360-ish or whatever it was, all the way back down to 320, I think. And then that's when I bought that $77 cost 425 call, and it just because the Bollinger Bands. But wait, you said you were going to talk about indicators. All right, let's talk about indicators. Let's talk about my favorite indicators. I just wanted to cover this because I know I mentioned it before, and nobody really probably understood what I was talking about. But before I get to the indicators, we'll pull one more subject that I've already made a video about, and I just explained really a while ago in the other video. I'll go back to black here. Limit sales versus market sales, right? The market sell or buy is going to give you the current price that you are meeting. So if you're bidding 5 contracts for a market order and the bid is at 7 and the current price shows 5, it's going to make it 7. It's going to give you 7. In some rare cases, if the price dipped just a little bit right when you placed your call, or not your call, your order, then you would pick it up at the lower cost. But with a limit order, you guarantee that you pick it up at what you want to pay for it. So say stock is at $10. I want to buy it at $9.90. Bid ask over here is say it's currently 10. So say the ask is 10, 07, and the bid is $9.99, right? So we'll keep a moderate little average there. All right, $9.90. Still crap. All right, so $10 stock price. All right, that's where we're at right now. The bid is $9.99. The ask is $10.07. You want to buy at $9.90. All this stock price has to do is dip to your $9.90, depending on how many shares you have, So say you want 1,000 shares, but somebody's only willing to sell 800 shares. All right, you guys read that? Sloppy, but anyway, say you want 1,000, but you can only get 800 at $9.90 because the next guy wants $9.92, no exceptions. Well, your order is going to sit there unless you decide to replace it and then pick it up at $9.92. Or you can continue to wait, and you need 200 more shares now, and say finally at the end of the day the stock goes back down. Now it's at $9.85. Well, your order definitely got picked up if it went to $9.85. In some rare cases, you'll get a better order than what you placed, aka price improvement. So if you put $9.90 and it went to $9.85, if it dropped on that candle hard enough to make it $9.85, you could pick up in between $9.85 and $9.90, or right on your mark. That is the difference between a limit order. Because if you hit market buy, these folks are asking $10.07. Chances are you're going to get slapped on that ask, and you're going to pay $10.07 versus $9.90. Now, this doesn't sound like a lot, but if you bought 1,000 shares, it can be a little different. All right, you can have a big difference there because it's such a large quantity of shares. All right, hopefully that breaks down the general concept of the bid ask and limit versus market. Now, you're in a position, you're in a call. I got a call for Tesla at 400. Well, I guess we'll keep it relative. 490, right? So it totally hit 498. That was a freaking beautiful thing. Just extremely beautiful. Shop, I said the other day in my chat group, or in Discord rather, in TCX, that it was going to be 430 inside of 3 months. That very same day it hit 422. I love the Bollinger Bands, and we'll talk about those soon. Call Tesla, 490. Say it's going up in profit. Man, I bought this sucker at $120, and now it's at 900 and we'll say $900, but now it's dropping. The stock price is going down. We don't know what's happening. My call's going to be out of the money. If it continues further down, it's still technically at the money unless the expiration is near. So say we got a week